macro, numbers which are coming in, especially with respect to tax collection, which has been subdued for now. The nominal GDP is around 8.7% for Q2, and that's also, in some kind of concerns as well.
Yeah, I think the problem for the Indian economy is not the real GDP growth rate, but the nominal GDP growth rate. Because inflation, I mean, achieving a 10% nominal GDP growth is somewhat of a challenge in the current environment. And I think government is doing its bit in terms of helping the demand side of things, particularly when it comes to consumption through income tax cuts or GST cuts or even the eighth pay commission recommendation. These would all come about in the next. It's already implemented, and you'll get the recommendations in the next 18 months. But I think, yeah, tax collections has not been that great, but I think they are on course to meet their, full year targets, because if the nominal GDP growth is 10%, your receipts can't be more than 10-11%. That's for sure. So yeah, I think third quarter and the fourth quarter, you'd see heightened economic activity, and that should result in better receipt collections for the government.
So, as an investor, Manish, what do you do? Do you ignore what's happening in the primary market? And is this the time to base build your portfolio within small and mid caps? Because by the time money moves back, you won't get these prices too.
Absolutely. I think, what do you do with the new money that is coming in, and how do you deal with this flurry of IPOs? See, all the IPOs are not bad, and neither are they at very elevated valuation. So it is a pick and choose between the primary and the secondary markets. Many of the IPOs are very, very overpriced, and it's basically a listing gain. Those should be avoided at all costs. Some are exorbitantly overvalued. They should be avoided at all costs. But I think a blend of both the primary and the secondary market is where you should look at. I think the main sectors to look at is basically your rate sensitives, capital markets, contra play on IT, because India is an anti-AI play, and overall IT spends in India, including the GCCs, are not going to see too much of a slowdown even in the current AI environment. So even IT is looking good. These are some of the spaces which, according to me, is okay. And keep some money in the portfolio for bullion, 10 to 15%, because of the woes of the US dollar. That should also be a part of one's portfolio. But we have got to keep a tab on valuations, and I would believe that valuations are the only case of worry as far as the stocks which are listed in the secondary markets or whatever is available. And I would reckon that if you are having somewhat of a bold heart and take a call on the broader markets, mid and small caps, from the next 3 to 5 year point of view, there cannot be a better time than the current situation. Stocks have already corrected 20-25%, more than 60-70% of the stocks have already corrected 20-25%. Maybe give it another 10%, but the upside is similar to what we saw as the upside in 2025, when we would have bought it in 2020. After the COVID, when there's so much of pessimism around the mid and the small caps, guys who have actually bought in and around those times have made a lot of money. Similarly, when you look out into 2028 or 2030, and you look back into 2025, this would have seemed a very good opportunity to build, quality stocks at very reasonable valuation.
Okay, and Manish, since you say